We are a group called Equilibrium. It's not just me, it's also Itai, it's Tori, it's Romo. And we are basically building the new family office. So we're a one-stop shop where you can get access to unique alternative investments in a managed type of portfolio. It is, we got some big news cooking up that we'll share with you guys in a little bit. But for now, I really want to turn it over to the man of the hour, Itai. He's our chief investment officer. He's a very good friend of mine. He is a genius when it comes to financial markets, so you should lean in on him. One day people will know about him all across the country, but for now, he's, for all 42 of you on this call, paying attention. So Itai, we're recording and it's on you.
Thanks, Jeremy. I appreciate it. So if you didn't see our previous calls on the USD number 1 or 2, I would suggest kind of watching that maybe a little bit later, but nonetheless, we'll touch on some stuff related to that before. So I'm going to share my screen. Does everybody see it?
Yeah, I can see it. So Itai, we're all visiting Equilibrium University. That's what's happening. And we don't have to pay $50,000 a semester to get in there.
No, even though it's learning from home. That's the going rate right now, right?
Yeah, it sounds like a good business model, you know, until
does it come with a free Microsoft Office subscription?
It does.
It does. So for everybody who doesn't know the running joke, Itai will not pay $7.57 to Bill Gates's wallet just so that he can actually have a functioning version of Microsoft Office.
Correct. Even though the notifications have disappeared, so that's pretty amazing.
Old habits die hard. Old habits die hard, man.
I know.
Oh, and Itai, one more thing, just because I've been getting some of these messages. If you want to get a copy of those previous recordings, just email me, or you don't have to email me. You can just ping me right here in this chat. So I am Jeremy Smith. Find me, shoot me over your email address, and I'll make sure that you get a copy of this.
All right, so we're Equilibrium, the family office for everyone, specializing in access to alternative investing through the web and a mobile app coming soon. All right, so I'll touch in some current market events before I skip into the dollar. It's somewhat related. So Michael Berry, we talked about him actually a few weeks ago that he was long GameStop right before everything was going on. And in his latest tweet, he says, US government is inviting inflation with modern monetary theory. We talked about that. That's the idea that governments don't really need your tax dollars and they can create as much money as they want. Talking about the debt to GDP, M2, money supply going up, retail sales, etc., are going up as well. And eventually, when the economy reopens, there's going to be a massive demand on the supply side causing inflation. So we see a little bit of that today with copper prices being as high as 2011, oil getting back over 60, and lumber futures actually making a new high, impacting home builders and things like that. So let's see what he refers to this. So here is our M2 money supply chart. So this is essentially the growth of dollars in circulation, and it did grow by about 28% in 2020, which is the fastest rate of growth in history at that short period of time. Here starts in the 60s. And what he refers to as surging retail sales, after a big collapse early in 2020, retail sales have indeed surged back up. And PMIs, or the production manufacturing index, has V-shaped since March, essentially back to where it was pre-COVID. So does this mean inflation's around the corner? Here is our 10-year spread minus the 2-year treasury. So you can see that it's essentially reached zero, or just about end of 19, early 2020, and have since went back up to about 1.3%, which has scared the market in the last few days. That's basically what they're talking about, higher inflation rate.
And Itai, why have people seen the 10-year go up?
Well, yields have gone up as essentially treasuries have sold. Treasuries in the 10-year, 20-year, longer maturity.
They just say that there's medical issue came up in the family.
If you're not speaking, can you please mute yourself? Thank you. Okay, Itai, continue.
Yeah. So my thought on this is not so fast. We have to remember that inflation is more than just the amount of money in circulation. So we have to remember velocity of money is still incredibly low and has taken a huge hit in COVID. So this is a way to look at velocity that's a little bit different than velocity of M2. Call it MZM. So it's essentially M2 minus CDs, because CDs and time deposits is money that's not available right now and has a maturity date. You subtract that out, and then this is the velocity of everything but the CDs. And that's been historically very, very correlated with inflation. You can see that big inflation in the 80s had a big pickup there. And now, amazingly, it's just a 1. So for every $100 spent, there's $100 that's regenerated in the economy, where in the 1980s, you're at 3.5 multiple. That's pretty incredible.
Itai, even if you go back further in time, have we ever seen velocity of money this low?
Never. This is the lowest ever recorded. And a part of it has to do with the fact there's just more money out there. So you can see here that the 10-year treasury here in red has been incredibly correlated with that velocity of money numbers. So 10-year treasury is also correlated with inflation, right? So as you have a higher interest rate in the early 1980s, you had a very high velocity of money, et cetera. So it's pretty much mimicked it quite a bit. So we have to remember that inflation depends on both money growth plus velocity of money. So when you have low and stable inflation, you usually have a growth of asset class or of asset prices. So we had the great moderation in the 1980s, 90s, et cetera. And now we've had a period of stable inflation that you had significant asset price increase with the S&P and real estate and all these things. Inflation usually comes in when there's a lot of demand for the money and there's more money out there. So why aren't we seeing more demand for money given the low rates? And I think the main reason for that is demographics. So something not fully talked about is the age wave. Here in the age wave is basically in red is the amount of people in the labor force that are ages 16 to 34. So you can see here in the peak of the period of inflation, 1980-81, over 50% of the entire population was that age group. And today they're just about 35%. So that age wave is incredibly correlated with inflation. And today you just don't see the same demographic pressures as you used to in the past, which I believe impacts the velocity of money.
Got it. And Itai, I know that you are very, very strong in what you've said about demographics in the past. For everybody that is on, can they expect a more in-depth demographics call sometime in the next month or so?
Yeah, absolutely. I think demographic is something very, very important to understand for economic trends.
Itai, I know you're just starting out the presentation, and typically questions early get answered later, but I'd like to ask you a question about velocity of money as to how it's actually defined. So, I buy a pack of gum at CVS or I buy a car, that's a transfer of money, but how are they transferring it? Because I just wonder with the advent of electronic payment and the fact that, for instance, I make one transaction to my credit card, versus in the 1980, I was actually paying people directly and things like that. Does that come in? Does technology change this?
It's a good question. I think it still counts basically because it still ends up with an end person, right? So if in the 1980s you went and let's say you purchased a car, what percentage of your money went to the car salesperson and what did he do with that money and how did he spend it? If today you purchase the same car, but you use let's say a credit card to do it, the end result is still the same, right? Because it's the same end people that get the money, and then how many times did they spend the money that they originally received?
Well, the cars might be a bad example because it's such a high purchase or it's a larger purchase. But even within businesses and things like that, the smaller purchases, again, if it's on credit, the other businesses are on credit also and potentially consolidating their payments. So I just wonder if it ends up that there are less payments as a result of some of the technology and the aggregation of transfer. Maybe, I don't know. That's what I'm wondering. When they say, when you come up with this ratio, what is the formula? I just don't know.
When they just look at the sum of transaction and how many transactions happen post that. So I think if you're even looking at something like a food truck as a smaller example, if you go in and you buy a taco, you can pay a credit card at the taco stand. In the 1980s, you paid cash, but the end result would still be similar.
I would argue that you're able to float more fiat money because you aren't having to deal with cash, and that the credit extends that even further.
Yeah, I tend to agree with that.
Cool. You want to continue?
Yeah, let's do it. So the way I look at it, if inflation is a real concern, I'm taking this extreme example of the Weimar Republic post World War I Germany. It's one of the most famous examples of hyperinflation the world's ever seen. So we do see that before the inflation hit between 1922 and 1923, but far before then, 1919, velocity of money was up 129%. 1918 to 19, even though output was down 18%. And 1920 also saw big increases in velocity of money with much smaller increases in output. And eventually inflation exploded in 22 and 23. And the markets were actually very steady in 1919 through 1921. It's actually famously, John Maynard Keynes tried to short the Deutschmark, seeing this, thinking it's going to collapse. And the Deutschmark actually went up, and Keynes said the markets can stay irrational longer than you can stay solvent. So that was actually referring to this period of time when he saw the data, but it was lagging by 2 or 3 years. So if inflation was a concern, I would be watching the velocity of money and seeing if those numbers actually tick up.
Got it. Is there an output level where if you saw output go up a certain amount, you wouldn't be as concerned?
Yeah, I mean, it just needs to catch up with the velocity of money. It doesn't make sense where output velocity goes up threefold, or in this case, much more, because output was negative. And that's concerning, where inflation's up, velocity is up, and output's actually negative.
Cool, thank you.
All right, so back to our dollar discussion. This is just a fun chart here, starting in the establishment of the Federal Reserve in 1913. Going into 2019, and the purchasing power of the dollar over time. It's significantly declining, but at the same time maintaining some of its purchasing powers against the rest of the world, which is the paradox here. Okay, so quick summary into what we talked about over the last 2 calls. The petrodollar system was established in 1974 with a deal with Saudi Arabia. US today is 11% of the global trade, 24% of global GDP, but 40 to 60% of all deals in the world happen in US dollars and much higher foreign reserves. So what are some of the problems with the USD control? There's an inherent flaw, which is similar to what we've seen in the Bretton Woods system that eventually caused the global standard to be dropped. Jeremy, you want to mention what the Triffin dilemma is real quick?
I was waiting for that call out. Thank you. Yeah, so the Triffin dilemma basically talks about the fact that we have this artificially high US dollar that is always causing a constant trade deficit. Because our dollar is so strong, there's always a demand for imports. As a result, we're running a trade deficit.
Right, so we basically have to supply the world with dollars because it's the global reserve currency, and as a result we deplete our manufacturing base and have a massive trade deficit. So here in 1974 the petrodollar system starts, and you can see the balance of trade of the United States basically explode. So as a result, petrodollar is most likely a contributor to the wealth gap inside the US. People in the services sector don't really feel it as much. They've benefited, but manufacturing, etc., because of the constant outflow of dollars, eventually that got outsourced to other countries. So you can see that median salary over time has stayed flat, adjusting for inflation versus the real GDP, and etc. That was talked about extensively in the first call. So the dollar cycle is self-reinforcing. Why? It starts with the fact that countries need dollars to buy oil, and after doing that for decades, a lot of the international financing is happening in dollars. So now you need dollars to service dollar debts. And now the dollar is not only backed by oil, but it's also backed by debts, which is a super strong reinforcing cycle. And most of these debts are not even owed to the US anymore. They're made between countries to each other. So in the past, foreigners would hold their dollar reserves in the form of treasury securities. And you can see it's correlated with the dollar strength, which makes sense, right? As the dollar gets stronger, foreigners need more dollars to service their debts. So they actually sell US treasuries. The dollar gets weaker, they accumulate it because that's a time that they accumulate reserves.
So the expansion of emerging markets is really mostly correlated with the US dollar index for anybody that has somebody say, I'm looking to go into emerging markets.
Yes. And again, feel free to watch the first 2 calls. We talked about that extensively. So basically, as the chart shows, the dollar cycles that happened in the past had a sharp reduction in the percentage of US debt held by the foreign sector. So even though the US issues debt like it did right now, there's just foreigners aren't buying it when the dollar gets strong. So eventually, when there's not enough foreign buying of US treasuries, the Fed has to fund it himself. And eventually that creates a shift that's dovish and causes the dollar to decline. And eventually that cycle has gone in the past 3 times. So strong dollar period, profits are stagnant. Strong dollar periods, profits have been stagnant. Strong dollar period, same thing. And during weak dollar periods, corporate profits accelerate. So eventually, when the dollar gets too strong, the US also runs into trouble. Exports are less competitive, and there's less demand for US goods. So in the 1980s, and again, last call, we talked about the 1980s period, it was easier to start this whole cycle just because there was so much less debt that there is right now. And nowadays, it's more difficult to stimulate the economy in the same kind of way. So again, what Jeremy mentioned, here's the emerging economies EEM index versus the dollar here in green. So periods of weaker dollar has seen quite a bit of growth in the EM and vice versa. Okay, so
Can we just take a second to appreciate Rob Ross's background of writing dollars? For anybody that's there, Rob always entertains us. He's supplying the entire call with US dollars. He is officially the petrodollar system. I'm sorry, Itai, I had to. I apologize. Keep going.
no worries. So problems with the current petrodollar system. So the flaw with Bretton Woods was that gold was continually drawn against external liabilities. The US was just printing too much dollars, and they didn't have the gold to back it up. So other countries converted those dollars for gold, and the dollar reserves just became too low. The problem with petrodollar system is the consistent trade deficits, because the US has to create way more dollars than it really needs to provide the whole world with it. So again, all the manufacturing base gets outsourced over time. So it made sense in the 1970s because US was the largest economy in the world and the biggest importer of commodities. The dollar was the only currency that was big enough to do global oil trade. But China is actually a bigger importer of commodities now, and it's difficult to maintain a system of oil and most commodities being in dollars, where the US is no longer necessarily the biggest trade partner. China can't replace the US because it's not large enough. So at the end of World War II, US was over 40% of global GDP. Today, it's much less, and it's difficult to maintain that. So you can see here the US portion of global GDP, and it's measured in dollars. So obviously it fluctuates with the dollar somewhat, but it's difficult to maintain the global reserve system when your part of the global economy continues to shrink. So we talked about the system starting to diminish. 6 years ago, for example, Russian exports to China were 98% dollar-based, but today it's only 33% dollar-based, and they're actually trading somewhat in euros and in their own currencies. What's interesting is that Russia's exports are mainly energy-based, commodity-based. So that's the heart of petrodollar. And Russia's exports to Europe have become more euro-based as well. And Russia has been having similar results with India. So slowly but surely, countries are moving away from petrodollar.
So why is the United States, with our big, strong military might, allowing this to happen?
So it's easy to go out to Iraq and take down Saddam Hussein just after he said that he'll start trading oil for euros. It's not so easy to do that with Russia. So China, for example, pays more for Russian exports in euros versus dollars. This is very, very recent. And we had a similar chart with India, but I won't get into it. So as you said, the question is to be asked, does the American military back petrodollar? So in 2000, Saddam started selling oils in euros, and we all know what happened there. For example, when you look at defense spending, the United States spends more for its military than all these nations combined to create a very, very strong enforcing petrodollar system. So again, US can't intervene military against major powers, China, Russia, India, etc. There has been periods of time when there were extreme sanctions against Nord Stream 2 from Russia to Germany, and actually got Germany to intervene against the US, just because the US was essentially trying to stop these kind of projects between Russia and Germany. They're trying to avoid some of that and still enforce petrodollar. We talked about all that. Okay, so where are we basically right now? So China is trying to subvert the petrodollar system. And that's actually relatively new, and it's surprising to me that it's not talked about more often. For about 7 years now, China is using the petrodollar system against the United States. The petrodollar system, what it does, it encourages trading nations to run the surplus with the US, right? Because if you think about it, the US supplies them with dollars, so they have more dollars because they sell more to the US, and eventually those dollars are being cycled back into the US to buy US treasuries. That's how it's been in the past. By doing so, they keep their currencies artificially low, and it makes their exports more competitive in US markets. So here's how it went in the past. So it started with Europe and the Middle East were the biggest trade partners. They ran these big surpluses, and to keep their foreign reserves in dollars, because they need dollars to service their debts, right? Because everything is priced in dollars, they hold those dollars in treasuries. That's why foreigners owned so much treasuries. That's why if you really think about it, China owning a huge amount of US treasuries is actually not a negative thing that China has all this US debt, because that's a way of taking those dollar reserves and putting it back into the US. So Japan did the same thing when it became really, really big in the 1980s. And then Japan later stagnated, and China became the biggest trading partner, and it ran these big surpluses. It invested that in treasuries as well. So that all changed in 2013. So the Bank of China basically says it's no longer in China's interest to increase reserves. And they were doing it for many, many years as they accumulated trillions of dollars in reserves. And today, China is not even the biggest owner of US debt anymore. It's actually Japan. So this has been something ongoing for about 7 years or so. And what they have done is the Belt and Road Initiative. So China started taking those dollar reserves. So again, they run a trade surplus with the US because they export more than they import. And then over time, that creates a massive amount of excess dollars. So instead of taking those dollars and buying treasuries, so they hold dollar reserves, they started taking those dollars and lending it out to infrastructure projects in Asia and Africa and Latin America and Europe, Eastern Europe actually. And China is known for being really good with infrastructure, and they've basically developed all of China. So a lot of foreigners were okay with that. So China's strategy, actually, they lend to countries that are not necessarily going to pay back those loans. And they're okay with that because they know that if they default, China essentially becomes owner of the infrastructure in whatever country it is. So they don't necessarily care. And as a matter of fact, a lot of times they actually want those loans to fail so they get control over the infrastructure, which is primarily in areas that specialize in commodities and hard assets.
Is this what we're seeing with China and Africa with a lot of the minerals and military style minerals?
That is exactly what you're seeing in China and Africa. So China now uses all that trade surplus from running against the US to finance all real hard, real world assets all over the world using paper. And this is a map of all the current Chinese projects around the world and how many loans and projects they've given. Here you see is the new Silk Road into Europe and a lot of stuff in Africa. Why? Because Africa is so commodity rich. Southeast Asia as well, and even in South America.
So what type of map would the US's footprint look like for these infrastructure projects across the world now compared to this?
The US doesn't have much infrastructure projects around the world at all. They used to in the turn of the century, but it's not, it has a lot of military installations, but it doesn't have as many initiatives like this.
Got it. Do you want to, I know you just said a lot, Itai, do you want to pause there and maybe take some questions from everybody?
Yep.
If the US did start doing infrastructure projects, what would you see them start doing? Just bridges and things like that, or what?
I would think that the US should invest in its own infrastructure projects first.
You mean like rebuilding a Wendy's in Atlanta? Or I'm talking about US projects. Where would they focus it?
Yeah, it's a good question because most of US allies are in developed countries and things like that. But the US could, in theory, compete with China by giving loans to a bunch of countries to develop their own infrastructure the same way China does. China uses US dollars to do it.
So is our infrastructure just building the big military and then taking some of it when we need it down the road?
How about the fact that, I mean, I think we're not giving enough credit to, for example, organizations such as the IFC, which are primarily US controlled and fund a number of infrastructure projects around the world.
That's true. And the World Bank, IMF, etc. But they don't aim to take direct control the same way as China does.
Itai, what type of increase in asset prices around the United States is a cause of basically all these countries holding USD and investing at USD back in the States? Yeah,
we actually will talk about that later. So there are two ways of doing it. You can either hold the dollars from, having the dollar as a reserve currency. You can either hold the dollars in treasuries, which most countries do as reserve, or you can invest it back into US assets.
Okay, so getting propped up a little bit from that as well.
Yeah. Okay,
Cool.
So we're good? All right. So the world is changing. Chinese officials said that reliance on the dollar system they see it as a security risk. And now that they're actually the largest trading partner and importer of commodities, China has a lot of interest in being able to buy commodities without using dollars. They want to trade commodities and they want to trade other products without using the US dollar over time. So this is a map of the world trade in 1991, right after the fall of the Soviet Union, where it shows you who is a bigger partner for trade for all these countries. Is it China in red or the US in blue? And you can see that the majority of the world is painted in blue in 1991. And this is how the world looks like in 2018. So when we look at that, we have to realize that when you look at the Belt and Road Initiative, a lot of the incentives for a lot of these countries, so you see a lot of stuff in Africa and things like that, is simply because China is such a big trade partner for them. So the bigger of a trade partner that they are, the more incentive they are to allow China to do these kind of infrastructure projects. And they see it as something that helps developing their country.
Itai, can you go switch back and forth between these slides again? Some of them want to see this. And also, Jeff has a good question here, which is, does this capture both trade in goods and trade in services?
Yeah, it's just global trade balance. So it's just the total dollar balance.
Okay, so this is 91, hit 2018. All right. Paul, you happy? That's a thumbs up. Great.
Cool. So there's no real clear solution to that problem. So, U.S. policymakers, they try to reduce the trade deficit today. You've seen a lot of rhetoric about that. Actually, it's been bipartisan. And a way to do it would be, well, we want to encourage other countries to buy more American goods, but it's difficult to do that because the incentives are not aligned to do that, because the US has to supply the world with more dollars, which eventually makes American goods not as competitive as other countries. So the monetary system today is designed to create those persistent trade deficits with dollars. And that's the only way to enforce the petrodollar, essentially. So on one hand, the US wants to fix the trade deficit, but on the other hand, it wants to continue the petrodollar system. And the strategy itself is not coherent, and it's been a bipartisan strategy ever since the 1970s.
I mean, I think one of the things we see, like when Greece had their meltdown, one of the things they did was deflate they devalued their currency to make it cheaper so they could kick up their exports.
Yes.
And it seems like countries are racing towards the bottom and just out trying to devalue their currency to kick up their economies, because they have short-term goals when it comes to politics.
Well, the reason the Greek crisis was so significant in 2010, 2011 was actually Greece couldn't do that because they were in the euro. So normally in past crises they did do that, but they weren't able to do that because they get the artificially strong euro to, for their economy it's too strong. Okay. Let's continue. So 2020 kind of changed everything. We had the COVID crash, and the Fed actually owns more treasuries now than all the other foreign central banks combined. So within a year, the Fed owned about half as foreigners, and now it actually owns more than all of them together. And in the treasury market, foreigners haven't been buying a lot because the dollar was relatively strong. So remember, when the dollar is strong, they need those dollars to service debts, and they even sell treasuries or they keep them still. And when the dollar gets weaker, then they have more reserves and then they buy more treasuries. So not only did that happen, in March and April, when the markets were crashing, there was this massive $1 trillion margin call in dollars going on around the world. And we talked about that. And foreigners were actually selling treasuries, and the treasury market itself, it's actually the treasury market more than the equity market that really freaked out the Fed to start that insane amount of QE buying in March, when the world was extremely close to a total meltdown. So at a time where the economy was very vulnerable, with the treasuries being sold, interest rates were actually spiking higher. So here's the treasury holding of the different entities. So here the Fed went from literally owning that amount of treasury securities to owning more than all of the foreigners combined in an extremely short period of time. So again, the FOMC talked about this in March of 2020. I'll talk about it briefly. They're basically saying the treasury market itself having consecutive days of deteriorating condition. Market participants said there was no liquidity, and if you wanted to sell treasuries, the bid and ask spread in one of the most liquid markets in the world was basically non-liquid at all.
And let's say that they didn't step in and help out. What type of doomsday things would we have seen across the world in that situation?
There was a massive dollar margin call. There was not enough dollars to cover it. And you would have seen the treasury market sink. That's actually the reason we've seen bonds sell with stocks at the same time. So we talk about that 60-40 portfolio. This is when correlations actually picked up and they were selling together. Gold was going down too because it was held in portfolios. So imagine the treasury market would have collapsed and interest rates would spike as a result. So even though the short-term interest rates were at zero, long-term rates would have climbed higher and higher. So mortgages, floating rates, and all these kind of things, that commercial real estate loans when they need the lowest rates possible because there's no liquidity and everything is crashing. Imagine, the 10-year treasury would have gone to 4 or 5%, mortgages going to 8, 9%, stock market collapsing.
Everybody defaults.
Everybody defaults. It would have been a true 1929 moment that we came very, very close to in March 2020.
So then we're basically on this path now. Whenever things get really bad, like somebody's going to have to come in with the dollars to make sure the whole thing doesn't sink.
Right. So that's exactly what happened there. So the Fed themselves said, look, this is what actually freaked us out. It wasn't the stock market. It was actually the treasury market. And here, this is that yield spike in March 2020. So initially, as the markets crash, money goes into the bond market. But then the markets crash enough that all the foreign holders of US stock, et cetera, get this massive dollar margin call. And then treasuries start spiking and markets are still crashing. And then the Fed comes in with $1 trillion, boom, like that, and takes that yield back down. And eventually they buy, a ton of treasury securities, mortgage-backed securities, support stocks, and put in $300 billion every single day, like truly unprecedented amount of intervention to stop this dollar illiquidity. So it's not just that we print money to print money, but we have to realize that we're printing dollars for the entire world, not just for the US, because there's a dollar margin call and the world simply doesn't have enough dollars.
Itay, how did the Fed manage to keep interest rates when you have the euro and other major fiat rates be below zero? How did they manage to keep it, at a floor of zero when they're just flooding it like that and the foreign, investors are not coming in?
Well, because they control the short term, they manipulate the short end of the curve and they set it at zero. Europe sets the short end of the curve at negative. So that's something that's just straight out in the control of the central bank.
Okay, but as the price goes up, they're driving the price higher, aren't they? They're driving the price of the bonds themselves higher when they buy it.
If they say that the floor in the U.S. is 0%, that simply won't trade. That's the discount window, and that's the Fed fund.
So this whole number is even more astounding, given that the U.S. is the only positive return, and the other countries still won't buy it. So what's that saying about their feeling about the dollar? Other than the margin calls. The margin calls were a short-term situation.
I think it's a little bit different because so imagine the way it would work is, imagine you are a oil company, and I'm just throwing an example. You're an oil company in Norway, and you build an oil rig off the coast. And let's say that you basically have now oil going to zero, and you're losing a ton of money, and you can't service your dollar-based debt anymore. So what you have to do is you hold some bonds in the US because you had dollar reserve, and that reserve was kept in treasuries. So now you have to go and sell those treasuries right now because you have to make those payments on your dollar-based debt. So take that scenario and multiply it by millions, and you find out why there was such a massive demand for dollars, which resulted in everybody selling treasuries because they need those dollars to pay those debts.
Right. So it's a margin call in everything.
Margin call, and that's what leaked into the treasury market because everybody holds their reserves. They don't hold it in cash. They actually hold it in treasuries.
Got it. Okay. Got it.
Cool. And Itay, there was one very interesting comment. I'm just going to read it. That came out as one thing to consider is the Fed backstopping treasury markets effectively allowed the risk-on trade to continue for emerging markets, preventing a reversal in capital flows to those countries.
I would agree with that. Because otherwise, if the dollar became too strong, it would collapse the emerging markets first, but it was still trouble for the entire world.
Yep. Cool. Continue.
So the Fed is still the biggest buyer of the fiscal deficits, right? We generate a fiscal deficit, the Fed buys it. And the thing is, you have $13 trillion in dollar debt, just like that Norway example we just had. And there's simply not enough dollars supplied to the world at times, especially times of crisis. So what happens when you have that crisis, foreigners sell some of their $42 trillion of assets, right? So they have 13 trillion in debt, 42 trillion in assets. And that crashed the US market, and that crashes other markets as well. So the Fed has to step in and print an insane amount of money to stop that. And that's what we've seen until there's enough dollar liquidity back. And it's becoming really difficult to maintain this petrodollar given those circumstances, because over time, and this goes back to your previous comment, there's something called net international investment position. So that basically measures how much foreigners own assets in the US versus how much Americans own assets in foreign countries. So if you take, let's say, the UK, how much do UK citizens own in the United States versus how much American citizens own in the UK and form as assets. So because the US is the global currency and exports its dollars elsewhere, yes, most of that money ended up in treasuries. And yes, China recently started using those dollars to fund projects around the world. But a lot of that money ends back in the US buying US assets, US bonds, US real estate, US stocks. And as a result, that international investment position of the US has gone very, very negative. So talk about, foreigners buying real estate and stocks, et cetera. This is the reason why that happens. They just hold a lot of dollars. So you can actually see US position today is just as bad as Turkey and Mexico. It's actually worse than Turkey as far as that category, and places like Taiwan, Singapore, Norway, they are big investors outside, and they own more than other countries than inward. So over time, because of the system, wealth concentration in the US is just about higher than any other developed nation. The top 1% in the US, you can see over the years, it's gone more concentrated, and now 35% of the wealth is owned by the top 1%, again, as a result of shipping away a lot of the middle income jobs and creating a bigger divergence. So the squeeze of that on the middle class, top 1% now owns just about as much as the bottom 90. And here we can see that since the start of the petrodollar and the end of Bretton Woods, we've seen productivity climb 252%, but hourly compensation has stayed flat, adjusted for inflation, since the 1970s. So again, the squeeze on the middle class, median wage no longer covers expenses, and especially the inflation of healthcare there, somewhat in housing, and it no longer cuts it, so it needs to find creative ways to find more money. So Credit Suisse actually says that although the US is very wealthy per capita, the wealth is extremely concentrated. So you see populism rising from both the left and the right. Nobody really, they have different ideas of what's happening, but they don't really understand the causes for that middle class squeeze. And you can compare that to, here's the US versus other countries, the difference between mean wealth and median wealth, based on that Credit Suisse research, is quite significant. What's funny is that you can actually think of Germany as similar to the US in Europe, because technically the euro is the reserve currency of Europe, but in a way it's a derivative of the Deutschmark, because Germany is effectively backing the euro and acting as the reserve currency of the European Union, right? So Germany is experiencing a similar thing to the US because it is a quasi reserve currency for that zone.
Itai, is there any data that maybe Dalio has or some of these other people about how far the 1% has to get before the system kind of turns on them and things reverse?
Yeah, he keeps talking about this being risky, leads to revolutions and all these kind of things. We're in a similar divergence in the wealth gap to the 1920s right now, and he has warned extensively about it. I think, it's difficult to project, look, it gets to this point and then boom, everything collapses, because things don't necessarily work that way. But it's just something to note, I think it's very likely that the reason this happens is because is simply because of the petrodollar system. And you see that too with ideological positioning of the major parties. So, here 1930s all the way to 1970, both political parties were fairly close to one another in the center, right or left of center. And there has been a significant divergence in the position of the two parties, basically since that starts. As that wage gap grows and as that middle class gets squeezed, you're seeing a bigger political divergence as well. Okay, so what's the intermediate term outlook? So again, making predictions is difficult, especially about the future, but US deficits are larger than most Western countries out there even before the pandemic hit. And this was the first time in history that deficits grew while the economy was expanding, especially a later stage of an economic expansion. So it was already expanding, deficits was growing. And this is the deficit now going in 2020, pretty significant compared to history. And here too, basically the end of gold standard, deficits started growing in general, and now they're pretty much reaching extreme. So what's going to happen? The dollar was propped up during that last cycle. So a lot of money was flowing into the US. And when the US had the strong dollar, there's a big trade deficits. And now the QE programs that come in and all the deficits that we're running, the dollar does have a lot of room to fall compared to the currencies of other nations. And we have to remember that the US stocks are today more expensive than most other countries when you're looking at their valuations and things like that, even when you're looking at the different sectors. So if US equities don't maintain outperformance and continue the way they are, money is global and can flow elsewhere, which could also weaken the dollar. So there's a lot of potential for a weaker dollar into the future. So you can see here the 1990s, US stocks did a lot better than the rest of the world. The 2000s, US stocks were actually negative for that decade. And then 2010 through 2020, US stocks have done a lot better than EM and all this other stuff. So if the dollar weakens in the 2020s, we're probably going to see EMs outperform again. So again, what are the risks here to the thesis? Is that European Union has a ton of problems. Remember, the euro has structural issues. The euro is a monetary union, but doesn't have a fiscal union. It will be the equivalent of having the Fed, but each US state is an independent country that can decide its own tax laws, etc., the same way Europe does. So that's what prevents the euro from getting too strong. It has this political risk. So if the euro currency collapses, obviously the dollar reserve status is going to last a lot longer than we expect. Now, China is a big enigma because nobody really knows what's happening in China's shadow lending economy. I think China lends more money through the shadow lending business than they do in actual banks. And China is always a potential risk for a big crisis out there. We talked about demographics too. China has a massive demographic problem, very similar to what Japan faced in the 1990s. And again, if inflation, and that brings us to the beginning of our call, if inflation spikes in the US, the Fed would be forced to hike rates and the dollar would even get stronger, which is problematic for the entire world. We've seen that, when that happens, US equity markets don't necessarily do well. If it happens too quickly, as we've seen, it can result even in a market crash. So for the long-term outcome, I think what's most likely to happen is really just a gradual decline that's already happening. I think events that are one-time event that causes a big market outcome, those are relatively rare. Things in the market develop over a long period of time. So the dollar would slowly decrease in value, will become less of global trade, especially in Eurasia. And more trade would just not happen in dollar. You can actually argue it already happened. So you can argue the system peaked here in 2000 and the amount of dollars being used is continually declining. So yeah, Ray Dalio talked about this. If you want to see some more information, you can feel free to go into the Bridgewater website. It has a lot of information about this. And countries have even started accumulating a little bit more gold, but there's no set currency that's really replacing the dollar. So slowly, dollar will decline and become one of these currencies that act as reserve. There's also the option of a fast restructuring that most likely would happen if the US itself decided it wants to be out of the petrodollar business. We could have either a Bretton Woods moment where countries meet together and decide, look, we're going to do something else. We're going to have a basket of currencies, maybe backed by something, maybe not. Some digital dollar with digital yuan, with digital euro, all together, each having a certain percentage of the commodity. And the way the US could really do it too is, and this is kind of interesting. The US itself, because it's the reserve currency, almost has no foreign exchange reserves. And emerging markets, because they're the most volatile and they need to defend their currency, have the most amount of reserves. So what the US could do is basically print money the way we do right now and use the money to buy foreign reserves. So you can see Switzerland has 115%, but that counts as gold too. So US 2% is basically gold. Switzerland 2 is gold. So the US could print money and just decide to build the reserves and use, buy gold or maybe even Bitcoin, I don't know. But essentially diversify and accumulate foreign reserve. And that will probably cause a big decline, could either be coordinated or not coordinated with other countries, and eventually reduce the dependency on the dollar and enable the dollar to weaken and start floating freely without the US supplying the world with petrodollars. So it's not that the dollar wouldn't be important, it'd still be a very important currency, but it will be a reserve currency. It wouldn't be the reserve currency. And there's some other, opinion. So for example, Mike Carney clears the path. So there's going to be digital currencies. Yellen talked today, I think, about the digital dollar. I think it's very likely that the next system will be decentralized. And I mean, he was talking about the Facebook currency as an interesting one to even privatize some of this. But I think the most likely is some kind of decentralized system.
I would think being governments, that they're always going to want to have some level as much control as possible.
Right, but because they don't trust each other, they may have a mediated, private corporations to figure out how to kind of decentralize this. But the idea here is that the petrodollar system is, probably won't be able to survive another 10 or 20 years. And the question is, how does it end? Does it end gradually with nobody realizing it, and 20 years later it's like, okay, it's not the system anymore? Or is there a coordinated effort to agree on something new, just like in Bretton Woods? And I don't necessarily know the answer to that.
Itai, petrodollar system goes kaput. The days of printing money are over, right?
They're not over, but the US wouldn't have the ability to print as much money as it does today, because now there's a global demand for those dollars everywhere in the world because it's needed for debts and other stuff like that. But at the same time, the US wouldn't need to print as much dollars either, because a lot of the money printing that goes on is because of foreign demand.
Makes sense.
Would they need congressional approval to enter something like that?
I don't know if that's an official policy.
Like Bretton Woods, they have to go through Congress for that.
Bretton Woods was official. Petrodollar has always been. So, in the first call, I referred to a really good Bloomberg article about how petrodollar started in 1974 and the secret deal that the US had with Saudi Arabia. I don't know if it's an official quote unquote policy.